You're 60 years old and you just inherited $1 million. You may be sitting here happy, but asking yourself a very important question, now what do I do? That's what we're going to talk about today in our video. Hello, my name is John Vandergriff. I'm one of the owners and the wealth planning team lead here at Blue Ridge Wealth Planners, where we help people with questions about retirement, but specifically in this area of wealth transfer, when they inherit money from their parents or some other entity, trying to figure out what to do with that money, how to make good decisions, but also how to weave that into the plan or the direction that they're already heading to make sure that they're able to manage this money effectively. Because the thing that we see in most situations is that inheritance without a plan is very similar to lottery winnings, where it comes in very quickly and it goes out very quickly. We don't want that to happen for the people that we're working with, and we don't want that to happen for you if you're in this situation. So trying to come up with a strategy of how best to utilize these funds doesn't mean that you don't get to enjoy any of this. It just means you're strategic about what decisions you're making and how that allows you to move forward with money that you didn't have a plan for, and how does that really correlate with the things that you're already doing. So first step we always like to look at here is first, what kind of money did you just inherit? Because that does matter from a tax perspective, but also from how you should position or think through these dollars moving forward. So the first area that we look at here is money that would be a pre-tax. So that would be IRA, or even if you inherit a 401k. These are dollars that have not had taxes paid yet, will be taxable in some capacity moving forward. And your choice is, do I want to have the bookends of either receiving this as a lump sum, which means all the taxation for that money would be to you this year, or do I want to maximize how far I can push that tax out? And again, as we look at this, you do have the option with pre-tax accounts to position that money in what is called an inherited or beneficiary IRA. So that would allow those funds to put into that account without having to take distributions immediately. You would at least have the option to push that until the next year. Before then, you would have a choice, depending on the age of the person that you inherited these funds from, where if they were currently taking RMDs or required minimum distributions, you will also have to continue taking RMDs from that account. But the maximum life of an inherited IRA that you inherit now moving forward is going to be at most 10 years after the date of death of, or the year of death of that person. So what you're looking at is either a scenario where you can pay the taxes upon receiving it this year, or you can start taking distributions pushed out as far as next year or 10 years, depending on the age of the person you inherited from. But once you get to 10 years post-death, this account will now have to be liquidated, and the entire balance will become taxable that year if you had pushed it forward. So most people we talk to, their strategy needs to be somewhere between these two. Most people don't want to receive hundreds of thousands of dollars in a lump sum. They also don't want to push all of that out to 10 years. So how do you build a strategy here to try to liquidate that as much as you can over time and really allow you to get the benefit of the way that these dollars are taxed and weaving that into what you're doing? Now, as we move from pre-tax to after-tax money, this is going to be dollars that will have usually one of two situations when it comes to how they're taxed. So most dollars that are in after-tax investments will get a benefit of what's called a stepped-up cost basis. And you say, what in the world is that? A stepped-up cost basis means most after-tax investments that you buy into have a cost basis that you purchase them at. So if you bought a stock with $10,000, that is the cost basis, which means that's the amount that's already been taxed. And if you never sold that stock while you were living, the increase that it had would have a capital gain that once that person dies, the stepped up the basis that was at 10,000 would now get stepped up to the current value of that stock, the date of that person's death. This same thing will also apply to real estate that you purchase, bank accounts if they had taxable interest, I guess. But again, as we look at this, this is a thing that applies to after-tax investments, except for annuities. And annuities are a little different because these grow as what's called a tax-deferred investment. So if you had a cost basis, which is still not taxable, the gain on that money is not capital gains, long-term or short-term. It is ordinary income taxable. And if the person passes away, you would have an option to either take that out and have all those taxes due, or some companies will allow you to do what's called a non-qualified stretch, which would allow you to kind of take those dollars out, and some portion of it would be taxable, some would be non-taxable. Biggest thing to remember, if you have an after-tax annuity that you inherit, talk to somebody about your options to see what you can do, because it's not a stepped-up cost basis situation for that investment. So now what's interesting, as we look at the different buckets, you will also get kind of as one that bridges the gap here. Life insurance is an investment that is tax-free as a death benefit. So if you receive life insurance proceeds as a beneficiary, you will not be taxed on those, but anything that you choose to do with that is going to become an after-tax investment with taxable growth. Same thing here, you receive it with no taxes, but if you don't sell that asset, or like you move into that house, that stepped up cost basis is your new basis, but from there forward, you will have a taxable gain. Same thing happens in this bucket here. If you receive these funds lump sum, pay the taxes, it now falls into this category, or you get to the end of 10 years, you now have an after-tax investment that's going to move forward with a cost basis that's going to be, based on the decisions and the selling and taxation that happens on that money over time. The only bucket that is going to be truly tax-free is if you inherit a Roth IRA or 401k. You have the option to also move that money into an inherited Roth account. And the neat thing with this is you're going to be able to have the same rules that apply to this inherited IRA with 10-year window to let that money continue to grow, apply to the Roth where it's going to continue to grow tax-free. So easily the best dollars out of any of these buckets that you can inherit would be in the Roth bucket because of the way that the rules work with that. Now, one thing that's a little wonky, if the person was RMD age, the government will require that you start RMDs out of this bucket the year after the person's death, similar to the inherited IRA. And you say, well, why are they doing that? This isn't taxable. That is true. They're just, I guess, limiting the tax-free growth potential of this bucket by forcing distributions out. But again, same rules apply. After 10 years, or 10 years starting the year after the person passes, is when this account would have to be dissolved. And at that point, these proceeds would jump into the after-tax bucket. So again, all of these end up going to an after-tax situation. It's just a question of, are we getting taxable growth until then? Is it already there? Or do we get tax-free growth for potentially 10 years before we have to move that money over? So may seem confusing. A lot of these things are important to make sure you have an understanding of what kind of money it is. And as we look at this particular situation that inherited $1 million, the breakdown of those assets was $400,000 from the sale of their parents' home. This is a sole beneficiary here. The combined value of the parents' IRAs was $600,000, and then they had $20,000 in the bank that we're not going to include in our planning perspective other than just bolstering the emergency fund that they currently have. So again, as we look at this, no taxation applies here because they had stepped up basis and sold the home pretty quickly after the parents passed. Obviously no tax basis here because there's no taxable gain there. And then on the IRA, the move here would be to place these funds in an inherited IRA so that they can stretch that tax burden out over a 10-year period instead of taking it all at once and forcing them into several higher tax brackets. So as we look at this, here's the kind of situation, because we need to understand what kind of money it is, but also how to graft that money into what the people are currently doing. So what we have here is a 60-year-old married couple. They currently have combined $400,000 in their 401ks. $20,000 is currently in the bank, so they're adding another 20 to that. And their goal now, when they came and talked to us, is are we able to retire now? We weren't in a position before this inheritance came in to do that. Now that this money has come in, is it possible for us to quit working and still make ends meet? So we're going to run through, a pretty quick look at this to see if that is possible. So again, main objective with this particular plan is want to retire now if we can. Their current need, net of tax, is about $7,500 a month, so $90,000 a year. And again, in Tennessee, since we don't have state income tax, they need approximately $98,000 gross of tax today to be able to give them what they need. So what we have here listed is their 62 values on Social Security. So this is what their annual amounts would be. So obviously with them being 60, they would have 2 years where they would have to pull $98,000 a year off of their plan. And then afterwards, Social Security together is going to make up about $50,000. So then they would have basically a net need from their money around $4,000 a month or $47,600. So as we look at this, currently they are sitting at $1,400,000 for kind of investment assets. The need here as a percentage is roughly 3.4%. And so again, most of the time when we're looking at a situation, we want to see this number be at 4% or less. So that gives us kind of an initial conversation to say we think retirement is possible depending on how these buckets work. And then kind of moving from there, it's really about how do we make decisions to help support this transition to retirement if this is something that they want to move forward on. Because again, if they're in a position where their annualized income moving forward is going to be $98,000 a year, that would give them a 12% tax rate. And then we know that obviously they're going to have of that $1.4 million, about $1 million of it in pre-tax. But again, $600,000 of that is going to have some special rules to it because it's that inherited bucket. And then the after-tax dollars here at $400,000, and actually $440 if you add their bank funds, gives them some money that's got a little bit of tax diversification to it. And also, this is a couple that did not have long-term care. So again, we're always after trying to see how much liquid after-tax savings does somebody have. Currently, they're in a position where they've got $440,000, so almost a third of their money, not quite, in a position to be there. That's not going to be a taxable hit if they did go into that in the short term. So as we look at this, obviously beneficiaries need to be outlined as we start to have this well-rounded discussion where even on these inherited accounts, you still want to make sure that each other in this scenario is listed as the primary beneficiaries. Now as these transition to their assets, they have 2 children, so they wanted the assets split 50-50 between those. So again, part of the process is getting their beneficiaries up to date. They had not currently gone through estate planning documents. And when you have a wealth transition like that, it shows the importance of getting this right. So they need, to execute kind of the baseline documents, which would be wills, powers of attorney for assets and health care, and living wills to give direction to the beneficiaries while you're living for medical decisions. This particular situation may or may not need a trust depending on how they kind of progress through things. Easiest way to get out of probate. So as we look at it overall, we have kind of a high level look at, okay, can retirement work? Now we want to transition over and look at some planning software to see if that is in fact possible. So a couple of things to point out here. This is showing kind of their pre or before inheritance situation. So $400,000 in their 401ks. So what we had is the kind of 401ks just in a baseline allocation of 75 in the Russell Growth Index, 25% in the Barclays Aggregate Bond Index. So that shows just kind of a breakdown between both of those accounts allocated that same way. And then as we go into, and again, the investment discussion is not the important part here. We can dial that in based on individual situations, but showing how these new funds grafted in. This is not Roth 401k money. So again, $600,000 that was coming from a 401k. As we see here, custom portfolio 1 is going to be a 60% Russell Growth Index and a 40% aggregate bond index. So looking at that, and then the key here in this software is applying RMDs to this, where we said, yes, this was inherited from a non-spouse, the year inherited, and then 10-year distribution with RMDs, since who they inherited these funds from was someone who was RMD age at the time that they passed. So again, we've got the retirement account there. Now we've got the taxable investment, again, in the same 60-40 allocation to try to be a little bit more conservative than their retirement funds are. So as we look at this, going into the plans, the first thing we want to highlight is kind of the probability of success in these situations. So current situation before inheritance with the $400,000, if they were trying to pull off a net $90,000 a year, even with Social Security factored in, 0% probability of success, and you'll see that on the chart over here. After inheritance with this Monte Carlo analysis, it's saying 87% probability of success, and again, without really tweaking and trying to make some decisions differently on some of what they're looking to do inheritance-wise. So as we look at this, when I open here in the Decision Center to kind of look at the differences there, because what we see here, and I'm going to do this in today's money, not an inflated figure, is current plan is what's in this navy. You see by the time we get to basically 2030, they're out of money, which is what they knew going into inheritance, why they couldn't make the jump to retirement the way they wanted to. But now what we see with those inherited dollars fused in, you do see here a 10-year run where you notice a drop here. This is where what's not been paid tax on out of the inherited account corrects and has a taxable event. But then we see them continue to have dollars through their age 90, which again is a good sign and leads to kind of an overall recommendation that would lead to retirement being a possibility. So again, obviously we would nail that in a little bit differently depending on the individual situation, but from just a high level projection, is retirement possible for this situation? Yes, it's just how do you pull the levers and make the decisions that are going to match up with the individual family. So as we look at this, you may be in a situation like we looked at here where you weren't necessarily able or ready to retire. You had an infusion of money from an inheritance and you're not really sure what to do with it. You may not want to retire yet. You may want to be retired today. But it's about walking through a high-level discussion of what needs to happen and making sure that you have a plan in place that allows you to do the things you want to, whether it's retire today or not. It's really important to detail that out first and then make planning decisions through that lens. So hopefully this has helped you understand what needs to happen if you do inherit dollars. And then going from there, if you've not been able to find somebody that can walk you through a discussion like this, we'd be happy to help. You will see below this video, there's a link that allows you to get onto our calendars. We would encourage you to do that, even if it's just an initial discussion to see where you're at. But if you're looking for somebody to guide you, help you make investment decisions, where do we pull money from? How do we create tax diversification if we don't have it currently? Those are the things that we do on a daily basis, and we would love to help you any way we can. And so hopefully you learned some things. If you got questions, make sure you leave those in the comments below, and we'll be sending out more videos like this in the future. So hopefully you enjoyed our time today, and we look forward to having you again in the future.